What did I do for 3 years? Instead of investing in stocks, I spent 3 to 4 years watching every video and reading all books and materials related to stock investing. Without exception, one day, by chance, I joined a stock investment study group of exceptionally high caliber, and at that moment, I felt a fear akin to terror, because even if they spoke briefly about something, I could already grasp the entire subsequent content. For your reference, that study group aimed to be in the top 1% in stock investing. After that, I began investing, and my profits have steadily increased ever since. Hello, this is ChoWorld. This video is uploaded with the intention of spreading a positive influence and is designed to provide a high-quality foundation before you start investing seriously, especially serving as a guide for those new to investing. Additionally, I plan to convey some of the know-how I learned from a 400 billion asset guru in my own style, making it even easier for you to understand, which I believe will add further value. This time, I will explain, in a more understandable manner, the basics of stock investing, which are essential based on the fundamentals I learned from my mentor, a 400 billion asset guru. The global stock market has shown strong long-term growth. The U.S. S&P 500 index has recorded an average annual compound return of about 9.8% since 1926. According to data from Robert Shiller and S&P Global, this index has generated tremendous wealth for investors over approximately 100 years. Although there have been repeated bull and bear markets behind these average returns, overall the index closed higher in about 73% of the years, and various financial statistics confirm that the stock market tends to trend upward in the long run. The power of compounding is extremely important. For example, if you had invested 10,000 in the S&P 500 in 1965, by 2023, that investment would have grown to over $2.4 million. This demonstrates, according to historical stock market data and S&P Global, that long-term investing can yield significant results despite short-term fluctuations. A representative example is Warren Buffett's Berkshire Hathaway, which achieved an average annual return of approximately 19.8% from 1965 to 2022. This is nearly double. When compared to the S&P 500 index's approximate return of 9.9% over the same period, many financial experts have confirmed this through Buffett's annual reports and evaluation data. In other words, buying excellent companies when they are undervalued and holding them for the long term, a key aspect of Buffett's investment philosophy, has been shown to significantly outperform the market average. This is the important point. On the other hand, investors who act based on crowd psychology, without a consistent investment philosophy, often achieve long-term results that fall short of the market average or see reduced returns due to frequent trading, a fact well known even among stock investment experts. Diversification and risk management are essential elements for stable long-term investing. During the global financial crisis of 2008, the S&P 500 index plummeted by about -37% in a year, significantly dampening investor sentiment. However, according to data from the IMF and the International Financial Association, portfolios diversified across various asset classes have shown some resilience against such sharp declines. In other words, an asset allocation strategy that includes not only stocks but also bonds and cash has played a major role in preventing the collapse of the overall portfolio. Ultimately, various historical financial data show that the market rebounded within a few years to recover its losses. And although the stock market has experienced significant downturns several times, it has recovered each time and reached new highs. This is also confirmed by analyses from various financial experts, including Robert Shiller. Therefore, rather than being swayed by short-term volatility, managing risk and staying in the market is crucial for achieving long-term performance. As a comment from ChoWorld, please do not try to time the market with short-term trades. You cannot do it. And not a single person in the world can. Anyone claiming they can predict or help you do so is a scam. I advise you not to waste your time trying to predict the unpredictable. Returning to the main topic, it is emphasized that adhering to consistent principles is key to successful investing. Even if the investment environment or market sentiment changes frequently, sticking to your own investment philosophy and strategy is advantageous in the long run. It is known that investors who avoid getting swept up in emotions, avoiding excessive exuberance in bull markets and panic, selling in bear markets, and instead adhere to principles based on company value and fundamentals, have consistently achieved good results. In the end, many experts agree that in stock investing, a patient and disciplined approach is the key to overcoming short-term noise and accumulating wealth in the long term. As a comment from ChoWorld, most people fall into this category, but a select 1% might not need to follow this method. If you belong to that group, then so be it. In today's modern society, where financial civilization has advanced, financial literacy and knowledge are extremely important for both individuals and the national economy. However, according to the OECD and S&P Global Financial Literacy surveys, there is generally a lack of financial literacy worldwide. In particular, South Korea is in a very serious situation, so much so that it is often described as financially illiterate and is following in Japan's footsteps. If you are still financially illiterate, you need to wake up. According to a global survey, 67% of adults worldwide do not properly understand basic financial concepts, which causes them difficulties in matters such as managing bank accounts, calculating interest, and dealing with the effects of inflation. This indicates that many people experience difficulties in everyday financial decision-making, as revealed by various studies. In South Korea, it has been noted that financial literacy is lower compared to advanced countries. According to the 2018 S&P Global Financial Literacy Survey, South Korea ranked 77th out of 142 countries, with only 33% of adults possessing sufficient financial knowledge. A brief comment from ChoWorld: this is merely about literacy. In reality, there are hardly any people who truly understand proper financial concepts, which indicates a very serious situation in Korea, even though the number of investors has recently increased. In fact, this phenomenon is observed worldwide. These results are also reflected in the findings of the OECD and S&P Global surveys, suggesting that despite Korea's high emphasis on education and high university enrollment rates, financial education has not been sufficiently provided. As a result, many young people rely on loans for investing or consumption, suffer significant losses during financial crises, or are burdened with excessive debt, as diagnosed by several domestic reports. In short, the lack of financial knowledge leads to personal debt issues and poor investment decisions. Please be cautious. The need for financial education is growing in today's economic environment. Financial markets offer a variety of options, including not only stocks and bonds, but also funds, insurance, pensions, derivatives, and more. For reference, according to S&P Global and Financial Market Analysis reports, the global market capitalization of stocks surged from approximately $65 trillion in 2013 to $111 trillion in 2023. Furthermore, with the advent of digital banking and easy-to-use investment apps, individuals can participate in financial transactions with ease. However, a lack of financial knowledge increases the risk of making poor choices since funds can be accessed effortlessly. As a result, for example, a lack of sufficient understanding of high-risk financial products can lead to significant losses, or neglecting the compound interest effect on loans can cause debt to snowball. Therefore, to truly understand financial culture, systematic financial education is needed from an early age, and proper financial education is also necessary for adults. Please take it seriously. Additionally, educational programs on financial planning and investment principles for adults greatly help improve financial literacy. Needless to say, citizens with high financial literacy are capable of making wise consumption investment decisions, enabling them to manage household debt stably and increase savings for retirement. On the other hand, structural issues in South Korea's financial culture have been pointed out. One of these is that household debt is excessively high. According to data from the Bank of Korea, Statistics Korea, and the OECD, household debt in South Korea is nearly 100% of GDP. In fact, various statistical data indicate that even when compared with major advanced countries, South Korea's household debt ratio is among the highest. Furthermore, according to data from the International Financial Association, South Korea's household debt ratio is among the highest in the world, and such excessive debt poses a significant risk to both households and financial institutions in the event of interest rate hikes or economic downturns. Consequently, domestic harmony is disrupted, leading to a rising trend in divorces. Moreover, if a significant portion of household income is used to repay debt, disposable income for consumption decreases, which in turn negatively affects economic growth. Furthermore, according to statistical data, approximately 78% of South Korean households' assets are concentrated in real estate, indicating that diversification of financial assets is absolutely necessary. Due to the perception that land and houses never incur losses, there is a tendency to invest all assets in real estate. When real estate prices rise, household wealth increases rapidly. However, if there is a downturn or decline, overall financial stability can be jeopardized. Also, real estate is pointed out as a problem because it is difficult to liquidate, making it hard to respond to urgent cash needs. In Korea's consumption pattern, private education spending, driven by a passion for education, occupies a large share. According to the Korean Educational Development Institute and various statistical data, this segment is very prominent, with the private education market exceeding 20 trillion won, indicating a serious situation. In fact, spending on private education for elementary, middle, and high schools reached approximately 26 trillion won in 2022, with data from the National Statistical Office and the Bank of Korea showing a 10.8% increase compared to the previous year. Such concentrated spending leads to a lack of long-term savings and investment resources, ultimately undermining Korea's national competitiveness and pushing everyone gradually toward impoverishment. Also, if pension savings or financial investments for retirement are delayed, it can cause problems in building future assets. Furthermore, while Korea has developed a culture of credit cards and credit lending that promotes consumption, it also contributes to worsening household debt. It is reported by the OECD and domestic statistics that on average, Korean adults hold about 5 credit cards per person. Also, financial supervisory data and OECD sources indicate that the annual number of credit card transactions in Korea reaches 129, which is far more than the 78 transactions in the United States. These figures show that Korean consumers rely much more on credit than on cash. Easily accessible credit cards encourage overspending, and the cost of this is eventually borne by higher household financial burdens through credit card bills or loan repayments. This creates a vicious cycle. In particular, during economic downturns or periods of rising interest rates, such debt burdens increase the risk of household bankruptcies and overall economic risks. Asset allocation is an important strategy for investment performance and risk management, involving the division of one's assets among stocks, bonds, cash, real estate, and so on. Each asset class has its own risk and return characteristics. Therefore, through appropriate diversification, the overall portfolio's volatility can be reduced and stability. For example, a portfolio diversified across global markets with 60% stocks and 40% bonds achieved an average annual return of about 6.9% over the past 10 years, with lower volatility than investing in a single stock. Thus, by investing in multiple asset classes, the underperformance of one can be compensated by the performance of another, potentially yielding robust, long-term results. An important point is that when making investment decisions, one must consider opportunity cost, which is the value of the alternative that is foregone by choosing one option over another. In other words, if you invest all your funds in one place, you miss out on other investment opportunities, and the difference in returns between the options becomes the opportunity cost. For example, holding an extra 10 million won solely in a bank deposit may be safe, but at the same time, you forgo the profits that could have been earned from other investments. Therefore, investors must carefully consider not only the expected return of each asset, but also the returns of the alternative investment opportunities they forgo by their choice. Also, over the past 10 years, the U.S. stock market has risen by an average of about 13% per year based on the S&P 500 index. Had you held cash instead of stocks, you would have only earned about 0.1% interest on deposits, as indicated by S&P. As a result, by not investing in stocks and holding only cash during this period, you effectively forego double-digit returns every year. In other words, when taking into account the compounding effect, holding cash for 10 years results in losing about 12 percentage points of excess return, according to financial market analysis reports. Such opportunity costs are in the end losses that arise from sticking with cash. Moreover, inflation is another factor that cannot be ignored. Economic analysts report that even if the nominal return is zero, the real value decreases due to rising prices. For example, if inflation is 2% per year, while the deposit interest rate is only 1%, then, in reality, purchasing power decreases by 1% each year. You might wonder if that makes sense, but that is what happens in reality. In other words, when viewed in terms of real returns, it is equivalent to a 1% loss. Therefore, holding low-interest assets or excessive cash results in a decrease in asset value due to inflation rather than preserving it. Ultimately, if opportunity costs and the effects of inflation are not taken into account in investments, not only will asset growth fail, but the real value will actually decline. The frightening part is that if these factors are not recognized, even if one builds assets with their salary over the years, it is difficult to say that their purchasing power has actually improved. Therefore, when allocating assets, it is necessary to carefully assess the expected returns, risks, and opportunity costs of each option, and to pursue investments that beat inflation. Global financial systems and cultures differ greatly from country to country. According to some data, while some nations have developed bank-centered indirect financing systems, others rely predominantly on direct financing such as stock and bond markets. For example, in Anglophone countries, such as the United States and the United Kingdom, traditionally, about 80% of corporate financing is obtained through capital markets as supported by OECD and U.S. financial market analysis reports. In contrast, in countries such as Germany and Japan, bank loans are the main source of financing, with European financial reports stating that capital markets account for only about 30% financing. As this trend continues, the likelihood of losing national competitiveness increases. These structural differences also lead to the formation of different financial cultures, market-oriented countries. Individuals actively invest in stocks and funds, whereas in bank-centered countries, people tend to prefer deposits, insurance, and savings products. Additionally, household investment cultures vary significantly by country. In the United States, for instance, investing in stocks has become so commonplace that it is often referred to as the country of stocks. U.S. households hold a significant portion of their financial assets in stocks, according to one OECD Ishant report. Stocks make up over 40% of total assets. This figure is several times higher than the stock holding ratios in Japan or Germany, 13% and 6% respectively, demonstrating that American investors participate very actively in the stock market. Additionally, in the United States, retirement pension plans such as 401k have developed, and even the middle class has been investing in equity funds from a young age, according to reports on the U.S. 401. In contrast, in Japan, trust in stocks has declined since the bubble burst, and in European countries, where social welfare systems are well established, asset allocation tends to favor bank deposits and bonds. In the United States, indirect investment products, such as mutual funds and exchange-traded funds, ETFs, have developed significantly. According to S&P Global and reports on the U.S. ETF industry, as of the end of 2023, the asset size of the U.S. ETF industry reached approximately $8.1 trillion. As a result, individual investors can now easily diversify their investments through low-cost index funds or ETFs, whereas in the past, asset management in countries like Korea or Japan was predominantly based on bank deposits and insurance. It is important to remember that such financial illiteracy can lead to a loss of national competitiveness and its consequent costs. On a positive note, several recent financial articles and reports indicate that since the 2020s, there has been a surge in ETF investments and direct overseas stock investments in Korea, leading to increased participation in capital markets. Such changes are important. Globally, due to the prevailing low interest rate environment, aging populations, and the spread of information sharing driven by technological advances, financial cultures around the world are gradually becoming more similar. In countries where financial systems are less developed, it is important to benchmark the investment cultures and systems of financially advanced nations and to adopt each other's strengths for mutual development. Therefore, it is crucial for Korea to recognize that moving away from its traditional real estate and bank-centered financial culture towards diversified investment and enhanced financial education in line with global standards is a key national task. Furthermore, no country is as fixated on appearances as Korea. Koreans themselves need to shift from a culture that prioritizes outward appearance to one that fundamentally builds national competitiveness by leading future industries such as artificial intelligence and electric vehicles, thereby gradually overcoming low growth. Finally, remember that adhering to principles in investing is extremely important. This has been ChoWorld. Thank you.